Good morning. You're watching The Market right here on 18 Hour with me, Asha Faridi, Anisha Jain, Nikunj Dalmia in the studios. And what a day it was yesterday. That 500-point swing for the markets, or the Nifty as well, intraday itself. And from that 21,500 peak, we're back to 21,150. I don't know how to explain yesterday's price action. I mean, not to say that days like these one couldn't foresee coming in the near future, but one didn't anticipate yesterday itself.
Aisha, look, what was the tone of commentary from last Friday? That the extremes in the market have got created, and extremes, such kind of an extremity rarely last. Momentum was extreme, flows were extreme, and the price action, participation was also extreme. So I'm not at all surprised that markets have corrected, and if markets would have not corrected, that actually would have added to froth, and that would have led to a bubble creation. Now, why did market fall yesterday? You cannot specify it to a particular reason, but say that there was profit booking and there was massive profit booking. And the reversal, I think, is reminiscent of what we see in a bull market, which is that it is very sharp, it is very severe, and before you realize that the correction has kicked in, the correction actually would get over. There was no trigger, both locally and globally, which really ignited this selling. So that means that it was technical in nature, that means it was local in nature, and that means that it really smacks of profit booking. Look at the reversal, the small cap, the mid cap, some of the rank mid cap stocks, they've reversed, and they've reversed 5 to 7%, even 10% plus in some cases from the intraday high. There you go. Look at the reversal. Yes Bank, Piramal Enterprises, Indus Tower, the real darling of market action, IRDA, 120 has come down to 105. So what happened yesterday was nothing else but extremes in the market which got created, and the extremes in the market have actually got corrected. That's year-end phenomenon or routine profit booking. But I think this is a bull market correction. Before we realize it, I think it'll get over.
But the only caveat here is, if you look at the biggest contributors to the fall yesterday within the Nifty, they are not names where you're sitting on profits. So it doesn't really smack of profit taking. It was Reliance, ICICI Bank, SBI, which have done barely nothing as compared to the other Nifty constituents.
No, the small and the mid cap stocks saw profit booking.
Sure.
And the profit booking, I think, was typical, compressed profit booking. The weak, players, they get shaken out. It's like a tree. And, when some momentum is applied to it, weak fruits will always fall. So I think it's that kind of a momentum. Where do we go from here, Aisha? Look, the template is that those will come to India, money is there on the sidelines, all that narrative does not change. So just because you've had a bad Wednesday does not mean that the bull market is over, that does not mean that FIs will not come back. I guess the extremities in the market were there, and the extremities in the market actually would get corrected. So I think in the medium term, when I say, in next 2-3 weeks, I think markets will stabilize, flows will come back because the template does not change. Having said that, I think for the year, I think we may well have peaked out.
Yeah, and just to underscore the point that you're talking about in terms of the technicalities, yes, India VIX also hit a 8-month high yesterday. The derivatives volume were the highest that we have seen in at least a year. And the fact that the RSI for Nifty, mid cap and small cap was trading above 80 for the last many days has finally cooled off. So they're out of the overbought zone yesterday, and that's the kind of shakeout we're talking about. And globally as well, we saw the rally reversing quite a bit. In fact, the US indices reversed the 9-day gaining streak. Also had the biggest single session decline that we have seen in S&P, Dow, Nasdaq since September to October. But of course, they've rallied almost 14-15% from those levels. So 1% retracement is par for the course. So that's how the global setup was as well. And then we saw the FI flows as well, wherein there was a outflow in terms of the FI data to the tune of around 1,300 odd crores, while the DIIs, they again were the saviors of sorts, because they pumped in almost 4,750 crores. Of course, Nikunj, yesterday the data was skewed by a lot of those block deals and QIPs, etc., and all of that. Not QIPs per se, but the block deals and large deals that were happening. But overall, do you think FIIs will come back this year? It's only likely to happen in the coming year now.
That's anyone's guess, but if you look at the history says that the last week typically is not a week which is a very active week in the market. And we've seen that whether it is year-end correction, whether it is seasonality, whether it is everyone going on a holiday, typically the last 7-8 days are not news heavy. They are not very heavy in terms of the global commitment. My limited point here is that why did markets rally? One big reason why markets have rallied is because of flows and because of foreign institutional investors and flows which have come from global investors. Will that template change in Jan? The answer to that right now is no. I look at the market in simple terms, which is that the downside in the market does not look large and the upside in the market in the near term looks limited, which means that we are likely to settle into a range. Look, we've gone up almost in a linear manner from October. It's a double-digit gain for benchmark indices. It's a double-digit gain for small and mid-cap stocks. And that gain may just get, you may actually see skim from the top. So the extremities in the market, I think, will get challenged. You may not see a lot of momentum in next couple of days because there is a truncated week next week. There is an FNO expiry. Open interest is high. You may not see a lot of follow-up buying. So I look at the terrain in the following manner, that for the year, I don't think you see a lot of follow-up buying, and you are unlikely to see a lot of downside also because at lower levels money will come. You have to come back and take a fresh guard in the month of Jan. That's where I think allocations will start coming back, and that's where I think you will see large cap stocks, they start outperforming. I continue to maintain that view, which I'm maintaining from 2-3 weeks, that it's time to shift 15 to 20% of your capital from small and mid cap stocks to large cap stocks. That's where I see margin of safety. And I think that really may be the template for first few days of Jan also. When flows will come back, they will move into large cap stocks.
Yeah, and don't be spooked by the price action yesterday. We were not alone in that, because across the world, you did see global markets see some amount of sell-off. I mean, look at NASDAQ, Anisha was highlighting about 1.5% cut coming in there. It's over a 220-point cut for one of the indexes, which has been the best performing in the world year to date. S&P as well knocked off about 1.5%, and the Dow as well fell almost about 500 points. Asia, by the way, is picking up on the same sentiment this morning as well. You've got Japan, which is knocking down over 500 points. Korea, Hong Kong, Shanghai, they're all a sea of red. And I think the GIFT Nifty too this morning is indicating a mild bit of weakness this morning for us as well. So yeah, brace yourselves. Yesterday could not be it. Okay, there's been some recovery since the morning, about a mild uptick now of about 0.2%. So fingers crossed, let's see how the day pans out. But let me take it across to Lisa, find out what the global commentary is like overnight. Lisa?
Right, good morning. So let me take you across through the global commentaries coming in. First, let me start with the UK inflation numbers that came in stronger than expected. Now, El Arian, he has highlighted that this can push the yields down, and also it fuels expectation of a 2024 rate cuts coming in from the Bank of England. Now, moving on to another important commentary coming in from Fed Reserve of Philadelphia, the President Patrick Harker, he said that central banks should begin to reduce the rates, and the rates should not be immediate, but it will, and this offers a softer pushback compared to what was seen across the widespread market expectation of early 2024 cuts that was highlighted by some of their peers. So yes, that was on President Patrick Harker. But moving on to an interesting report coming in from Citi Asia Quantitative Insight. They said that the price momentum was a big winner in 2023, but going forward, it faces a seasonal reversal in January, because the price momentum, it was positioned in in regions like Taiwan and Korea. It was overweight as well as in India, but it was underweight in Hong Kong as well as in China in December. And they also see typically a reversal. Historically, they have seen a strong reversal in the price momentum for Jan. Jan has usually been down around 1.6%, while Feb has seen price momentum falling, a reversal in the price momentum by 2.3%, and that exacerbates the volatility at the beginning of the year. So that is what they are highlighting. And in a volatile environment, they recommend a balanced approach, that is value plus quality. And their QARP strategy is now overweight for financials, for energy, and they are overweight on regions like Korea as well as Hong Kong, while they are underweight on tech, healthcare, consumer discretionary, as well as they are underweight on India as well as Taiwan. So that's the important global commentaries coming in across the globe.
Okay, let's take it across now to our chartist. Lisa, thanks for highlighting all the global commentary and find out what went wrong in the market yesterday. Kunal and Nooresh are here as always. Nooresh, hi, morning. Let me come to you first. What explains yesterday's sell-off? And did you see that coming? Because in the morning you had a buy on the Nifty, right?
So yesterday was a hold and now we get to a buy today. So if we look at the Nifty, we saw a move from 19,500 to 21,500, 600. And we do see some bit of correction coming in December year-end calendar year booking across the world as such. We've seen that correction in the last 3 years as well. And this could be again a sell-off, which some bit could come even today. And that should be an opportunity. There were two big gap ups on the Nifty, 20,950 to 21,070, and the last one at 20,500 to 20,300 roughly. So ideally, I would expect some recovery from this 21,074 to 20,950 mark. So a buy on dips today. Expect a slow and steady recovery. Overall, a good correction like this is needed for the trend to continue. And this is part of a normal uptrend. So this dip is a buying opportunity across the board.
Okay, the dip should be taken in as a buying opportunity for now. But what's your take, Kunal, that ferocious sell that we saw yesterday? Should be worried about that, or as people have been calling it, healthy consolidation?
So good morning. Yeah, I think it was something which was not, something which we forecast for the indices specifically. And now, in terms of whether it's a buy and dips, I would probably maybe wait out for another couple of trading sessions before we go into any kind of a major recovery on the indices, because now the first important support for the Nifty lies at 20,700, 750 mark, from where we bounced off or made a dash towards the 21K mark for the index, I think last week or so. So I think that forms a major first support, and we've historically seen that whenever the index gets into such a kind of a sharp sell-off, it tends to break those round figure or psychological marks. So we've closed about 21,100, 140 mark yesterday. So I would believe that we could probably be breaking the 21,000 mark, hopefully in the next couple of days. And I think that's where one should probably try and take opportunity. So 20,750 remains to be the first leg of support, and we'll see if the index drops down to those levels. That could be a good buying opportunity.
So you are anticipating lower levels from here?
Yes. So after such a kind of a sharp sell-off, there's bound to be a natural reaction, because traders would want to cut their leverage positions, and I think that trimming of positions, etc., ideally sells the index further down.
But your idea of Nifty going to 25,000 ahead of election, that is still intact, right?
Yeah. So these jerks will keep on happening. As you say that, when the trend becomes obvious, the ride becomes extremely difficult. So I think the trend was obvious since last 500, 700 points, and now the ride is becoming a bit different.
Okay, so with 25K intact as a target from Kunal, let's find out what are the individual stocks to bet on for today. Nooresh, what's on your list?
So I'll continue to stick to the PSU names, the fresh ones which have broken out. So first is the bank SBI, State Bank of India, which gave a breakout above the 620, 630 mark, which was the previous all-time high, which got tested multiple times. After making that move to 660, a retest of that band should be a buying opportunity. So a stop loss at 615, a target price of 720 plus in the short to medium term. Second is a buy on ONGC, which is a multi-year breakout. The stock was last at 190, 200 in 2018 to 2019, as well as in 2021-22. Multiple times it made a top around that area, and now we are trying to break out above that. Yesterday also the stock saw a good spike, corrected with the markets, but closed well in the positive. So a dip today should be a buying opportunity. A stop loss at 190, target price of 240.
Okay, Kunal, what about your stocks?
With HDFC Bank as a first pick, relatively low beta, and even yesterday I think the stock behaved in such a kind of a similar fashion. So I'm expecting similar behavior for HDFC Bank. Would suggest a buy with a target of 1700, stop loss at 1630. And UPL is another stock which has confirmed a reversal of sorts on the short-term charts after a mild recovery. So would suggest a sell with a target of 560, stop loss at 580.
Okay, so those are the top recommendations coming in for the day, but which are the stocks which are likely to be in news? Well, top of the heap is DLF as well, because they're looking at making a fresh launch, and given the demand scenario that we have seen, it's likely to be, flying off the shelves, as they say. So Amit is here to discuss all of that with us. So Amit, about DLF, what are the just saying, and what's the chatter on the street?
Well, they are expected to launch their first 500 units of Arbor 2, that is in the Previana South in Sector 77 today. Now, last time when they had launched the first part of this project, the stock was up around 11 odd %, and similar kind of reaction is what the brokerages are expecting from the stock, given the fact that it's a 28-acre property. The average selling price of this property is around 18,000 per square foot, which will lead to a potential revenue of close to 9,000 crore rupees. Now, this includes around 7 towers, 1,113 units, and which includes also 14 penthouses. Now, they are expecting the company to launch the first 500 units today, and they are collecting around 50 lakh rupees as 50 lakh rupees check for booking as a booking amount. So even if the company manages to sell around these 500 units in the month of December, that would translate into pre-sales of close to 4,500 crore rupees. Now, this will take the first 9-month pre-sale amount of 9 month of FY24 pre-sale amount to 8,800 crore rupees, while they had given a guidance of only 13,000 crore rupees, which clearly shows that the company, that is DLF, could easily beat their guidance for the financial year FY24. In fact, even after Q3, they could come in and upgrade their guidance. So that we need to watch out for. But this this completely depends on how the pre-sales of this project goes on. But analysts are very bullish on this new project that the company is launching today.
Coffee bullish.
We do links for both Hindi and English.
No, that
Because
is
is that why you're going to Delhi with the 50 lakh check booking?
No, you can do it online if you want, actually, these days. But not that I'm booking. No, see, look, the company is in a sweet spot, guys. For a company which was struggling post-COVID, the real estate demand in the NCR region, which is where the mainstay of DLF has been exponential. The NCR region is one region where the real impact of RERA has really taken care, has really visible now. There were dozens of estate developers pre-RERA. Now only handful of them are left, and DLF in a sense is the biggest one there. The stock has seen a run-up. So you cannot say that the stock is cheap, it's no longer a contra buy. But one thing I think is given the way of momentum I think is there in the entire NCR region, DLF launches, I think they will continue to surprise us. Operating leverage has kicked in, financial benefits have kicked in. You can always argue back and say that, okay, DLF is expensive, but typically real estate stocks, they do well when interest rates have peaked out. Typically real estate stocks, they do well when you actually would see a peak in commodity prices and when new launches are there. So for DLF, I guess it will be a warm stock. The level of outperformance may come down and should ideally come down after the recent outperformance. But in terms of a trajectory, interest rates down, big macro advantage, always a headwind. B, commodity prices peaking out, always a huge advantage. And C, the slew of launches what they have got, one after another, they're stitching up new launches and just they're getting accepted by the market both in terms of demand and price point very smartly.
Because you were talking about the excesses in the system when it comes to the key stock markets and the mid-cap and small-cap. Do you think there's a bit of an excess right now in the real estate?
Anisha, see, typically real estate will always do well when interest rates are going down. And you talk about affordability. I think the affordability of real estate, at least in some of the big projects what builders and developers are launching, I think is not that bad. You take out some outliers in the luxury market, you take out some ultra luxury projects out, you take out some HNI, ultra HNI buying a penthouse somewhere in Narman Point. Take all that headline out. I guess in general the affordability levels in real estate have gone higher. Look at a city like Mumbai where we live. We understand the city. Last 7 years prices have been flat with a positive bias. But affordability in last 7 to 8 years per capita actually has increased immensely. The wealth effect of stock market, and now we are saying the stock market belongs to the common man. Look, why do you invest? For a better future. And what is better future? Real estate and housing. So if Indians are investing much in stock market and stock markets have gone higher, that's where the money would come in. So the wealth effect in a sense will always be there. And plus, this is a sector where, what is the risk to the sector? I don't think it is demand or macro. The risk is valuations. And it's anyone's call right now what is the right value for DLF and for Prestige, given that this is one sector where consolidation is so large that good quality companies are there who are getting acceptability with institutional investors. And if that was not enough, your sovereign and your global funds are coming at project level now. So there's no dearth of cash, which I think will keep the entire real estate, juggernaut rolling.
Yeah, absolutely. Okay, Yatra online, initiation by Investec. Samit, I would think slightly late in the day, considering we've been talking about this travel boom.
Well, this initiate note is very important because if I tell you, where in a scenario where IPOs have been buzzing a lot, this is one IPO that has not gone up the shelf. Their issue price was 142, current market price is 132. Even the listing was quite muted, and now Investec has come out with this note where they're initiating buy with a target price of 215, which suggests a potential upside of close to 63%. Now they're clearly saying that Yatra has been losing market share in the B2C segment, but that happened due to funding constraint. Now given the fact that their IPO has been successful, this company might be able to invest better in supply agreements, and this will result into better airfares, better hotel rates, and in turn their market share could increase when it comes to the B2C segment. But on the other side, what Yatra has done is they have built the largest enterprise OTA business. Now the OTA business is nearly 3x more profitable than the consumer business and is currently in the early phase of adoption. And if you see, Yatra is the largest player. In fact, they are 3x larger than Make My Trip, which is again a larger player when it comes to the B2C segment. But Yatra is a more bigger player when it comes to the more profitable segment, that is the OTA segment. And the total addressable market of this enterprise OTA segment is close to 1 lakh crore rupees, and Investec is expecting around 5,000 revenue to come in towards OTA over a time period going forward. Now what Investec is expecting is Yatra's revenue, EBITDA and PAT could grow at a CAGR of anywhere between 22 to 87% over FY23 to FY26, and on the valuation front, they are valuing Yatra at around 22x PE for 12-month forward PE, which is still at a 20% discount to the market leader in the B2C segment, that is Make My Trip. So that's the reason why this note is important.
Samant, I'm actually surprised why the stock did not get this kind of a response when it went public, given that, right now there seems to be like a universal acceptance in terms of where travel is there, where B2B travel is moving, and they're moving actually into the enterprise business as well. I'm yet to really understand the core of the enterprise business, the entire B2B business, what they're doing. But purely if I took numbers, EPS estimates for FY25 and 26, and for this kind of a business, you have to look at FY26. It's at 13 times. Now 13 times for a company which Investec feels that will have a growth of 22% and 60% is surprisingly cheap. We'll have to do a deep dive to understand that what the core business is, but if I put what Investec is trying to project, the headline is travel will grow. It's a competitive market, but if the growth in the B2B business is so strong, and if you're looking at estimates of like 25, 26, we're looking at P multiples of 14, 15 times, then the stock is actually cheap by any yardstick. That's my limited point.
Okay, those are the two stocks on focus. That's DLF as well as Yatra Online. But the list doesn't end here. There's lots more to talk about. For now, we're going to take a very quick break. Nifty implied open seems like the selling at least is going to get arrested to start off trade with. It's indicating a flat start. We will talk about all of that in this short break. Back with the market right here in ET now. The GIFT Nifty indicating a quiet start for us after that vicious 500-point fall that you had from the top of the day. Seems like at least to start off trade, it's going to be a flat move. Post that, what happens is anyone's guess. But let's talk about individual stocks and let's look at the management meet highlights of Venus Pipes. The company seems is all geared up for faster growth in exports and aims to take it to 5,000 tons per year over the next 5 years. Gaurav is here with the highlights. Gaurav?
Nuvama met with the management of Venus Pipes and they have some highlights coming up. Now management seems to be very bullish about the company's outlook going on. They believe that they are going to increase their export because they have got some product approvals from European Union, and they also have some strong team coming up for the exports export focus. They also believe that they are going to use the same strategy, success strategy that they used in the European Union in other regions as well, like US and the Gulf regions. With this, they are expecting the exports to remain in the range of 5,000 tons per year, at least for the next 5 years. Let's also talk about the capacity addition. Now, the company recently added capacity of 38,400 tons in its portfolio in FY25, but beyond this capacity addition, they are expecting the capacity to increase almost with a CAGR of 15% over the foreseeable future. They also believe that the current capacity utilization will increase because there is some push coming up from the government to use the BI certified products, and there is also anti-dumping duties which are happening in the imports, which is going to push the capacity utilization higher. Let's also talk about the profitability. Now, Nuvama believes that with all these push coming up from the management, the profitability could increase with a CAGR of 54% over the next 3 years, and that is why now they have revised the target price and they have revised it upwards to 1758 rupees, which gives us healthy upside of around 30% from the current levels. Let's also not forget that despite being a capex heavy company, company's debt to equity ratio is somewhere around 0.2 times, and the free cash flow is also strong for the company despite the capex that they have taken. So Nuvama all in all believes that this recent stock that we have seen in the company is actually an opportunity to buy for investors. So it will be really interesting to see how investors react to this positive commentary coming up from the management.
Thanks, Gaurav, for that. But it seems like Motilal Oswal Financial Services also conducted its management meet with the analysts. What are the key takeaways and what's the buzz about the value unlocking of the housing finance vertical? Let's go across to my colleague Asesha to find out more.
Well, yes, Elara Securities in fact met with the management of Motilal Oswal, and on the back of that they've come out with this report. First up, they've spoken about operating profit after tax, which is expected to grow at a CAGR of about 15 to 20%. As far as their dividend payout is concerned, it is expected to be in the range of 25 to 30%, and they continue to maintain their IRR target of about 17.5%. As far as their target market is concerned, they say that they continue to target customers with higher household savings, and they are also building a strong wealth management team which will help in growing their business verticals. As far as their affordable housing segment is concerned, they say that they are targeting a growth of about 20 to 25% in the affordable housing segment. They are looking to list their affordable housing segment after the demerger, and they are also open to any other opportunities as and when it comes up. So it's positive commentary that has come in from the management of Motilal Oswal, and the stock in focus on the back of this.
Right. Well, the big news this morning has really been all the way hearing currently on the FAME 2 subsidies as well. So let me quickly take it across to Srishti, my colleague, and get a better sense on, the committee meet for FAME 2 schemes extension which transpired, and what's the proposition right now. Srishti?
Well, yes, a big news coming in where the Parliamentary Standing Committee has sent a slew of measures to boost the adoption of EVs in the country and recommended the extension of FAME by 3 years. Do remember that the FAME subsidy cuts that were announced are getting over by March 2024, and the Parliamentary Committee has raised concerns about the Ministry of Heavy Industry two-wheeler subsidy cuts in June, urging its restoration by 3 years. And the committee also emphasized including the private four-wheelers and quadricycles in the scheme. Other than that, some of the other key recommendations include that they have recommended for e-bus fund allocation to expand under the FAME scheme, explore possibility of shrinking further the GST on lithium-ion batteries to bring down the ownership cost of EVs, and they have also recommended some cuts on the GST, and they have recommended that EV should be brought under the priority sector lending. They have recommended to develop the sodium-ion as an alternative to lithium-ion battery manufacturing, and possibility of shrinking further GST into that as well in terms of the battery manufacturing, so that the overall cost of the EVs should come down. So these are the recommendations by the Parliamentary Standing Committee to the Ministry of Heavy Industries, and this is very crucial to note because all these two-wheeler companies were getting impacted because of the cuts in the two-wheeler EV subsidies. So if this goes through, it will be a big booster for the two-wheeler EV industry. The companies in focus will be from the likes of TVS Autos, Grief Scott and Bajaj Auto, and from the passenger vehicle space, because this is also talking that inclusion of four-wheelers should be there in the FAME subsidies. Then companies like Tata Motors will be in focus too.
Okay, so that's a very important news flow that you should be tracking, but just a disclaimer that these are the recommendations so far. It's not a final decision, so we'll see how it progresses, but the recommendation stands in favor of these electric two-wheeler and four-wheeler companies. But it's been raining IPOs, a lot of action that we have been seeing. Of course, today the listing of Inox Limited as well, when we are expecting the listing to be at a premium of almost 70-80%. Yesterday, the subscription completed for the likes of Muthoot Fincorp, Moti Sons Jewelers, Suraj Estates, etc. And for Moti Sons, the subscription was as high as 173 times. So clearly a lot of interest in the IPO market. Today, of course, is the second day of subscription for the likes of Happy Forgings, RBZ Jewelers and Credo Brands Marketing, and IPO opens for Innova CapTab Limited IPO as well. In fact, let me take it back to Srishti to get a sense as to what this company does, why are they raising funds, and what are the brokerages saying on the same. Srishti, about Innova CapTab?
Well, yes, the IPO opens today of Innova CapTab, and investors have a chance to apply for this particular IPO till 26th of December, where the total IPO size is 570 crores, in which 320 crores is the fresh issue, which the company plans to utilize for the repayment of some of their debts for the companies on books, as well as some of the debts by a subsidiary named UML. They will utilize some funds for the working capital requirements and some for the general purposes. Other than that, if we'll talk about what the company does, so they are into the CDMO business. They have an integrated pharma business. They are into a lot many space like R&D, manufacturing, drug distribution, marketing and exports. Have a diversified generics product portfolio of over 600 products marketed in India, and their CDMO domestic business is quite heavy, wherein it contributes around 70% in their overall revenue. They have exports branded generic products to 16 countries. There they have exposure to. And other than that, if we talk about the financials, that have seen quite a good jump, though the margins for the past 3 years have been in the range of 12 to 15%, 12 to 14%, I beg your pardon, but the company's profit has actually jumped from 34.5 crores in FY21 to 68 crores in FY23. So that's about Innova CapTab, a domestic CDMO business heavy that the company is getting in. If we talk about some of the key players in what are there in the clientele list, then companies like Cipla, Glenmark, Lupin, Vocard, Ares, they all are their clients, and the company also manufactures product across the span, which includes acute as well as chronic therapies. But lastly, if we talk about the valuations, then 1 year forward valuation, as we calculate, stacks up at 30 times. In comparison to rest of the peers like Suven Pharma, Laurus Lab, the company looks like that this particular IPO is fairly priced at what the company is coming in with the price band of 426 to 448 rupees. So on the valuation front, looks like this IPO is fairly priced.
Okay, Srishti, we'll leave it at that. Thanks for that IPO update. But the December RBI bulletin is projecting a potential growth, or rather global economic slowdown in 2024, and is also foreseeing interest rate reductions amid the global disinflation. Ankur Mishra, my colleague, is here with the takeaways from that.
Yes, definitely. The RBI bulletin clearly states that in 2024, global economy may slow down. However, if you talk about India, that will continue to perform well, as it has already done so with the corporate profitability numbers, with the data which is coming in. India has performed well in terms of global peers, and that is likely to happen in 2024 as well. However, on the inflation front, Reserve Bank of India's bulletin clearly mentions that in FY25, that is 2024 and 25, in first 3 quarters, 4.6% is likely to be achieved. Now, this is important because Reserve Bank of India is mandated to keep CPI between 2 to 6%, that is 4% plus minus 2%. And if it comes around 4%, that will be interesting to see that how MPC will take action post that. If you remember Monetary Policy Committee meeting, that Reserve Bank of India governor had clearly stated that he needs to see CPI durably at 4%, and it should not be one of the event. Now, all in all, economists will try to derive that when Reserve Bank of India will start cutting rates, because there was no hint, at least in the last policy from Reserve Bank of India governor on that front, and he continued that war from inflation is not over.
Amnish Aggarwal joins us, Head of Research with Prabhudas Lilladher. Let's take a conversation forward. Amnish, good morning. Thank you for joining us. What do you make of yesterday's price action? Very sudden, very sharp. Do you think we've peaked out now in the short term?
You see, the market was actually overheated to some extent in, you can say, many small caps and several segments. So if you look at, say, past few months, the rally was, although the index was also moving up, it was led by small caps and mid caps, and many large cap sectors, they were not performing to that extent, or rather they were underperforming the broader markets. So my sense is that yes, there could be some more cut which can be there in the small cap, mid caps. So definitely, I think maybe say in the interim now, at least in the mid cap, small caps, there could be a pause, and the next leg of rally might be led by the large caps. That is what my view is.
At what level you would, in a sense, recommend your clients that they should now start putting money to work? Because there's a lot of FOMO in the market. I mean, one day of correction is not going to change the money which is on the sidelines, which is desperate to come in.
You see, there is no, I would say, timing the market has never been a good strategy or is possible. The main thing is that one has to be very, very stock specific, and when one finds that the stocks have come to more reasonable levels, then one can actually start buying, because this is not, I would say, the end of the bull market, or there is no change in the stance as far as the economy or the markets over the medium to long term are concerned. So very difficult to, you can say that whether one should start buying or few days down the line. I think it should be very stock specific. And when one finds that the stock has come to a particular level, which is reasonable and good, one can start buying into the market.
Is reasonable, or what you would like to buy at 5-10% decline?
Yeah, Nikunj, is it for me?
Yeah, that's right.
Can you repeat again,
No,
please?
what do you think is reasonable, or where do you think 5-10% decline you're happy to buy it?
Okay, I think our sectoral calls don't change. For example, banks, if you look at, say, particularly the private sector banks, they have not moved up. Whether you look at, say, past 6 months, 12 months, they have been gross underperformers, and they still remain reasonable. So any correction in the private sector banks, so that can be, I would say, a good entry point. Then some of the, you can say, names in the capital goods, yes, they had rallied somewhere like, you can say, C1, ZVB, or even some mid-cap names. So if they correct to, say, maybe another 10%, 15%, that they could be good picks. So similarly, some of the names in particularly your healthcare, hospitality space, hospitals, they continue to look good, and a few names even in the, I would say, discretionary sides on which we have been very positive. So it is going to be very, very stock specific. But if you look at broader pockets, then in broader pockets, banks, hospitals, your capital goods, as well as some of the IT names, they could figure out in that list.
Okay, point taken. So those are still pockets where there is some valuation comfort. But Nooresh, wanted to get you into the conversation. Z Entertainment is going to be in focus today on account of that entire flip-flop. Finally, we understand that there's no formal extension yet, but the talks really continue. So that stock will be in focus on account of that. And the other space, Nooresh, which has been coming back is the entire agrochemicals. Today as well, HSBC has written a note. They have increased the target price across the board, whether it's UPL, PI, Dhanuka, Rallis as well, which they have downgraded. What's your take on this space?
So starting off with Z, over the last 1 year, every time there has been a slew of positive news, it has made a top around the 290-300 mark, whether it was October of last year or very recently in August as well. And on the downside, 220 to 230 has been a major base. So if one wants to take a speculative bet here, you need to take it closer to 230 levels. The recent lows from October to November are around 240. So out here, would not expect a correction beyond 240 to 220 levels. On the upside, a major trend change happens about the 300 mark. So as of now, it should remain range bound. In terms of agrochemicals, yes, the sector is interesting because it's gone through a sideways phase and a downtrend for majority of the names. But we are still not changing trends as such. We continue to see corrections on every bounce back. The only interesting name is Rallis India, for the fact that it has done nothing for almost last 10 years. Now we've seen good volumes come up in this bounce back from 200 to 260. So closer to 220 to 240 is a good accumulation zone for Rallis. And eventually once it crosses 270, that would be a long-term trend change. So out of all the names, as of now, Rallis is the one which is making a bottoming out formation.
51 rupees. It's just been a heck of a volatile stock. Amnish, do you like anything from the recent IPOs, which you like the business but you don't like the price?
You see, if you like the business, I think Tata Technologies was, I think it was a good IPO, although post-listing the stock rallied very sharply. Among, I think, if you look at say some of the other names, I think one IPO which is currently open, which is your brands. I think that is another company which looks interesting. It is coming at something like 23 times trailing earnings. But otherwise, I would say in IPOs which have come recently, I wouldn't be able to give any major names in that, because many of them post listing also they have run up quite a bit. So
Time to
no
understand.
big names over there.
IDA, what's happening there?
IDA, you see, again, if you are buying, you can say a company just because it is funding the renewables, trading at more than 3.5 times, I think it doesn't make sense actually, because the froth which is getting created today, you are getting the best of the private sector banks or the companies which have got much bigger balance sheets at 2.5 times, 2.6 times. So buying a stock at 3.5 times, like IDA, I think it doesn't make sense at the current juncture.
104 rupees, but remember it had become 120, but 32 became 120. 120 has become 104, so it is still 3x from the issue price per se. That is something which is worth noting. Kunal, railway stocks yesterday reversed. Power stocks yesterday reversed. The reversal in mid and small cap stocks is nothing short of scary. I mean, when you see IRFC, RVNL, IRCTC, they fall by 9, 10% in a day. And from the intraday high, the reversal is even sharper. It shakes you, right?
Yeah, of course, Nikunj. And I think after such a kind of a price action yesterday, where the markets were just taken by a complete surprise, there's bound to be a cutting of positions. And for traders who have been riding onto these stocks, I think losing out maybe another 3-4% from the top, skimming from those levels just to try and exit, I think would still be a fair kind of an observation. I think what matters now is that whether these stocks and what are the set of stocks where the selling stops first and then there's some bit of gradual buying. I'm not saying very sudden buying, but a very gradual buying pattern which emerges, because I think that would determine how the market texture would be going forward. So one thing is for certain, that after such a kind of a sharp sell-off, traders would try to avoid taking too much of risk on positions, mid caps and small caps. They would probably try and go into those defensive large cap names, maybe FMCG, maybe a few of the pharma stocks. They could probably try and get a lot more advantage into this kind of a market scenario. So I think we'll have to wait out for the next couple of days to see whether it was just a one-day sell-off or whether there's a bigger pattern in the making for the indices.
Amnish, what's your take on DLF?
The real estate as a space, we are very positive about, and I think the kind of turnaround which has happened in the entire real estate sector, that is going to last, because this is usually not a 1 or 2 year cycle. So the cycle has got reversed after 8 to 10 years, and I think the cycle is going to last, and DLF being the large player and the formidable player continues to look good, and one can actually look at DLF on declines.
Nooresh, railways, defense, power. Do you think in the near term, when I say near term, 2 to 3 weeks, is the trade intact or is the trade over?
So I would say majority of these names already had done way too well. So it's over for the near term, at least in the railway space. Defense maybe still could make a comeback slowly and steadily. Power again, power is the most promising one, because that is where it's a sector which had gone through a 2-year sideways phase and then made this move. So if I were to look at a Tata Power, the stock gave a breakout above this 280 mark recently, went up to 340. That comes down to 300. It becomes an interesting buy in this case. Same is the case with JSW Energy, which went sideways. The last stop was around this 400 mark in 2021. So power as a sector looks promising, because it did not see a 3x, 4x moves which has happened in defense and railways in the last 6 to 8 months. So the view is power stocks on a decline still look promising. Railways and defense, ideally when you have a 4x move from the bottom, a 20% cut from the top would be normal. We've just corrected 10% as of now.
Now, next year, if flows come back, will they come back into large cap stocks? Amnish, you look at the market from October and flows are back. But whether it was yesterday's price action or in last 40-45 days, HDFC Bank and Reliance, which in a sense are the flag bearers of FI ownership and flag bearer of FI activity, they've underperformed. I mean, FIs were not there, they were underperforming. Logical. There's logic in it. But FIs are back and then yet they are underperforming. Does not, it's difficult to connect.
That's what I was referring to, that the broader market was being led more by, I would say, mid caps. And if you look at most of the large cap names, so Reliance is one, HDFC Bank. Even if you look at, say, ICICI if you look slightly longer over the last, say, 12 months or so, even ICICI Bank hasn't done anything. So I would say it's a classic case that not only you see the markets in the last 6 months, it is not only the FI money, it is the money which is coming from, you can say, the SIPs, which is coming from the local PMS, AIF, that is, you can say, running the market. And when it comes to HDFC and Reliance in particular, I think Reliance is more like an event-driven stock at this point of time. It has undergone long consolidation, and the kind of initiative it is taking in new energy and some of the emerging segments, I think the major value unlocking is going to come from here. And that is why the stock has been range bound for some time. If we exclude the value which has been created under Geo Financials, the returns have been, I would say, moderate over the last 2 years. Similarly, the case with HDFC Bank, I think now the contribution to Nifty for this stock is also high, and the stock was, I would say, significantly overowned a couple of months back when the actually merger took place. So given the fact that these two stocks have got a considerable weightage and they have not performed, that actually makes the case that once they stop, when they start performing next year, there's a good probability that the large caps might outperform mid caps for some time.
Overnight, of course, there were order wins that were announced for Mazagon Dock as well as Cochin Shipyard as well. So for Mazagon Dock, there's a 1,600 crore order that they've signed, and Mazagon Dock close to around 400 to 500 crore rupees. So these stocks will be in focus on account of that. But talking about order inflows, it seems like that there might be some order inflows coming in for the power infrastructure companies as well as overall road infrastructure. And this is an exclusive that my colleague Sameer Dixit is bringing for us, talking about how government is planning to electrify the Delhi-Jaipur stretch and what would it mean with respect to individual companies that have shown interest. Sameer, tell us the details.
Continuing its focus on infrastructure expansion, Modi government is likely to come up with the tender for the highway construction worth over rupees 1.5 lakh crore. This tendering process might be initiated in next 2 to 3 months. Government focuses that this tendering process should start before the model code of conduct comes into place. It is likely that the general election date announcement might be there by mid of March, and before that, government wants to at least initiate the tendering process for this 1.5 to 2 lakh crore of highway construction project, and the tendering process has to be started for the same. But we are also picking up from our sources, and even the Union Transport Minister Nitin Gadkari has said that they want that there should be small bundle that could be up to rupees 1,000 crore, and that could be that could initiate the entire very smoothly, for a simple reason that a project worth rupees 1,000 crore and above usually requires cabinet approval. And if we go by this route, a project having up to a quantum of rupees 1,000 crore, then this cabinet approval process might it will be skipped. So with this focus, government wants to initiate the tendering process, and they want to come up with the highway construction project that could be to the tune of rupees 1.5 to 2 lakh crore. In a move to push electric mobility in the country, the government is now focusing to have a first electric highway in the country that has already been identified. Delhi-Jaipur is going to be the first electric highway. And the interesting part is that government has started receiving the interest from multiple big names. The first name that government has disclosed is Tata's. Tata have shown keen interest for India's first electric highway, Delhi-Jaipur highway. But government wants to execute this Delhi-Jaipur electric highway on the BOT model, which is build, operate, and transfer. Nitin Gadkari, who leads the transport ministry, he has suggested that if we go with the BOT model, then 51% equity can be held by NHAI, the government entity, whereas 49% goes to the operator, who will be responsible for the operations, for the financial aspect as well. And this BOT model will also be helpful in getting a very subsidized rate in power procurement for the operator, which could be somewhere around rupees 3 to 4 per unit. So this is a very big development where government has received interest from Tata for India's first electric highway, Delhi-Jaipur highway.
I want to go back to PSUs. I mean, if I may use a Hindi line and say that PSU stocks ne is saal chakka mara. They've hit out of the park, out of the stadium, out of the city. Everything applies for them. This is the best year for PSUs or the PSU index in last 10 years. Now, I think, Nooresh, let's just remind our viewers of that lovely data which you shared with us. In 2010, the market cap of PSU as percentage of the total market, Nooresh, was 25%, right? 2020, it came down to how much, and where is it right now?
So if we go back to those times, right from 2002 to 2010, we used to be 20% in 2001-2 as the percentage of total market cap. And in the peak of 2008-9, we were closer to 30%. Since then, it continued to drift lower over the next 10-11 years. And by October 21, this number had made a bottom around 9% of the total market cap. So the whole PSU basket was almost closer to 25 lakh crores or lower in that case. And then we started making a turnaround. Even today, it should be closer to 13 to 15% of the total market cap. We had a lot of recapitalization and dilution in that period of PSU banks. So if we look at a lot of stocks in the PSU banking names, the prices are way off the highs of 2008 purely because there has been a huge recapitalization. Now what do we see is we've been seeing rotation across the PSU space. So the last year was all about NTPC, which continued to remain a favorite, and now a similar stock is ONGC, which has done nothing for the last many years, 15 to 20 years. Nothing has happened to the stock and is now making a 5-year breakout. Similarly, it was all about PSU banks, the smaller ones last year, but it could be SBI, which is the largest one, which looks most promising for this year. So in this play, PSUs, it has been a rotation. It started off with some of the shipyards, then we got defense, then we got railways. So now I would look at names like OMCs also on dips, as well as ONGC, SBI.
Market cap, what they've added. And then it's only when you look at the numbers, you realize that OMG, how big the comeback in PSUs has been. From shipping to defense. At start of 2021, guys, 2021, this is not 2001, 2021, not 2000, not 2001. 3 years, almost 3 years, and the market cap has seen a 3x jump. Yes, it includes some IPOs which have also come out, but in general, that's been the surge in some of the PSU stocks. Nobody liked them. They were called the ugly ducklings, the favorite whipping boy. PSU banks had to be rescued. OFSs were not finding any flavor. LIC was bailing every government paper out. Defense stocks, when they went public, there were hardly any takers. At the peak of pandemic, some of the shipping companies which had raised capital from the market, they went below the offer price. Everything, whatever could go wrong had gone wrong for PSUs. But looks like now whatever could go right is going right for PSUs. So Amnish, for 2024, do you think this entire PSU juggernaut will continue to roll, or it's time now to jump off the train?
See, if you look at, say, past 3-4 years, the data for which has been shared, so a lot of uptick has actually come from, one is clearly the banks. The second is you can say railway stocks. And as far as your oil companies are concerned, I think depending upon the oil prices, they continue to say move up and down. So I think in some of the segments where the PSUs are still playing, for example, the railways, the defense, or some of the newer names, I think there could be, say, still run up in the long term. But yes, it will not be possible to replicate the kind of return we have seen in the past couple of years. Whether these are stocks, you can say on the railway construction side, whether these are defense PSUs like your HEL, BDL, etc., they will continue to give you secular returns from here. But definitely, it might not be possible for each and every stock in the PSU basket. Similarly, if you look at the banks in particular, the PSU banks, they are still trading at, you can say, less than 1 price to book. If their books continue to be the way they are, if they continue to further upgrade their technology like they have done in the past few years, then the very fact that there is likelihood of now further consolidation of PSU banks, then the further uptick in the price to book of PSU banks can't be ruled out. But now the return should become at a more reasonable rate and not like Some of the stocks we have seen actually going 3x, 4x in the last 12 months, but that might not repeat.
The word coming in as far as the PSU sector is concerned and the valuation so far. In terms of the defense sector as well, these stocks will be active. Nooresh, what should one do for the likes of Mazgaon Dock, Cochin Shipyard and even other names like Bharat Electronics? Should one buy more positions in it?
So I would say wait it out. They've had a huge run. And for now, the correction is also not large from the highs. So if I were to look at a PL, which still looks the most promising, it has had a relatively lesser move compared to the other names. It recently gave a breakout of 145, 150. It just corrected from 175 or to 167. So at least a dip to 150 to 160 band is where you want to buy. So not buying a sector which has gone up 3x to 5x on a 3-5% dip would ideally need a 15-20% correction to make it a risk reward trade as such. So avoid at current levels, wait out for some more correction.
Amnish, why is IT doing well? I mean, Accenture numbers were not that impressive. There's nothing very great about what we've heard from many of the IT companies in terms of where they see IT demand is moving. But the index has given 20% return. Normally, when the index starts, IT stocks they start outperforming when the sector is on a turn in terms of going higher. So, what are markets excited about?
I think as far as your fundamental performance is concerned, there is nothing much to excited about as of now. It might take, say, at least a couple of quarters. I think the recent run-up in the stock prices has happened on account of two things. One is primarily the hope that there might be some interest rate cut in the US market. And secondly, the IT sector, if you look on a very broad basis, all the large caps, they have significantly underperformed most of the indices and most of the other stocks. So these two factors have actually led to that. It's more like that when everything else has moved up, then people start looking for stocks or the sectors which have not moved up. And that is where IT sector has come in, and valuations there, they are not like what they had gone in the 2020-21 cycle. So post first wave of COVID, the way IT sector got re-rated, even today, despite growth being low, their valuations are significantly lower than that. And I think these two factors have led to, you can say, a sharp pickup in the prices of some of the IT stocks in the last, say, 10 odd days.
Kunal, I want to, flag off what we were just talking about, the December seasonality. What is it that you've typically observed of the market, say in the last 3 years, since the COVID recovery up until now, as to how the market peculiarly behaves in December?
So I think there was this interesting data which was seen that around 20th of December there is a 3 or a 4 day of sharp swing sell-off, and so mid caps, small caps, of course, being high beta, they would probably correct more, and the Nifty being a relatively low to moderate beta corrects a bit more less. So ideally, I think the correction for mid caps and small caps in the last 3 years has been the tune of 8% to 10% on an average, as compared to Nifty, which is 6%. Post that, what happens is after that 3 or 4 day of sharp sell-off, you see almost like a V-shaped recovery. So I think in 2020 December and 21 December, the 2 dates, the index, both small caps, mid caps, they have corrected by a margin of say 10% and then come back to make a new high in the month of January, the following month. In 2022 was the only exception where the index did not make a new swing high, and I think it took 2-3 months of more consolidation. But then the bounce even in 2022 post that December sell-off was to the tune of 10% after a sell-off of more than 14%.
Okay, interesting observation there. Let's see what transpires. We've just had 1 day of selling in the last 3 months or so. But Amnish, so great having you on the show today. Thank you for taking the time out.
Welcome.
Okay, that's the fundamental take coming in from Amnish Aggarwal. Just want to mark the market pre-open rates as well, because don't go by the Sensex rate. That's bizarre. These rates will settle down. I don't think it's going to be a gap down of 1.5% and 2% that you're seeing on the screens right now. I'll skip those rates for now. Let me quickly take it back to our chartists and get in some mid-cap trading ideas as well. Nooresh, anything within the mid-caps that you're looking to buy or sell this morning?
So would be looking at a stock which has seen a huge move and is coming back to retest, that is GMR Infra. The stock made a breakout about 65 odd levels, went up to 78, and in the last 2 days has corrected a good 6-7%. Today's gap down closer to 68, 70 mark would be a good entry point with a stop loss at 65, and again a bounce back towards 80.
So Kunal, what about your mid-cap ideas?
So I'll go with Voltas as a buy. We discussed the stock yesterday and the day before. The stock breaking past about the 950, 960 mark yesterday, then correcting towards 930 levels. So would suggest a buy on the stock even at current levels of 930 approximately for a target of 970. Stop us at 900.
Okay, seems like we're headed in for some more weakness this morning. The pre-open rates after that sharp gap down continue to actually see some more selling. So 20,922 is where you're currently at. So headed in for a breach of 21K perhaps this morning. Tell you what, we'll take a very quick break. We'll have these rates settle down further and perhaps should resurrect back to that 21K level.